Good. Welcome to everybody once again. We'll, I see there's one more, Jabulani. Morning, Jabulile. Okay. Now, I'm not going to dwell on the history of the coronavirus and the COVID-19, the more technical name. What we're going to do today is we're going to have a brief look at the impact of COVID-19 and the lockdown and the combination of that on the economy in the first instance, briefly, but then also certainly what the impact would be on property investment. Now, if we talk about property investment, please keep in mind that this is residential property investment in a very specific, defined market segment. So we will not be looking at the impact on commercial, industrial, and agricultural property. That's a separate discussion, and I can immediately tell you, just for interest's sake, if you're interested in that somewhere in the future, that the impact on especially commercial and industrial property is going to be burdensome, to say the least. It's a dramatic impact that they will feel. Morning, Michelle. So, for our purposes, let's have a look at I took a few articles from News 24 as a starting point. Now, Lamiz Omarjee, I actually enjoy reading this person's articles because it is insightful. And so this article, you can see all of it before you. I want to emphasize, this was on the 15th of April, 2 days ago. The national lockdown instituted to slow the spread of coronavirus will lead to irrecoverable financial losses for SA businesses and compromise trading conditions for the remainder of 2020, according to the South African Chamber of Commerce and Industry. Now, that speaks for itself, and by now all of you would know, and if you don't know, I'm telling you now, that since lockdown commenced, the Reserve Bank responded by cutting the repo rate with 2% in total up until now. So what is interesting about that is we're going to have a look at it a little bit later, is the reality that this is unheard of. For as long as I can remember, we've never seen it. Gerrit, you can correct me if I'm wrong.
Sorry?
You spend your career in the banking industry.
Hyphen, no.
And let me just manage everybody and mute them. So there we go. I've muted all of you. So Gerrit, if you want to respond at this point in time to the history, this is unheard of. As far as I know, since the Depression of 1929 in the United States especially, we've never seen an economic reaction as bad as this. And as far as I know, it was probably in during or about 1984, the last time that the Reserve Bank dropped or cut the repo rate with at least 2% during a period of 4 weeks. I'm not sure if you have any more info about that, but this is as far as I know. So it is history in the making. So I don't know, Gerrit, if you will deal with it when we get around to your input.
Yes, thank you. Yeah, Gert, I'm searching quite frantically. As I saw something this morning on someone that posted the last 60 years in rate cuts and ups and downs. So you carry on, and I'll see if I find it, I can make reference to it quickly.
Okay. If you don't find it, don't stress too much, because I'm pretty sure of my facts. As I said, the Great Depression, that was probably the worst, actually far worse than now. And then during 1984, with the international chaos at that point in time in the financial markets, was a similar situation where the Reserve Bank dramatically participated in the economic salvage process, and during a period of, I think, 6 weeks, actually cut the rates in total by approximately 2% or 200 percentage points. So there you see it. The result of this is that the repo rate currently is 4.25%, and the prime lending rate at this point in time should then be, if I do the calculation quickly, 7.75%. Gerrit, just nod if I'm right. Good. What is interesting is that the International Monetary Fund, IMF, also started voicing serious concerns. This was actually on Tuesday, during Tuesday. They consider this to be the worst economic downturn, there you have it, since the Depression of 1929. Now, I know most of you, if not all of you, who are participating in this seminar, and not one single one of us was actually alive at that point in time. As a matter of fact, my parents, who are 88, 89, were also not around yet at that point in time. Now, what is interesting is there's a little bit of conflict. And if you're wondering why I'm dealing with the economic issues in so much detail, you'll see there's method in my madness. There's a little bit of conflict regarding this. Can you see if I highlight? Yeah, you should. The IMF expects the SA economy to contract by 5.8% during the course of 2020. Now, keep a few things in mind here. The first thing is we're already approaching the end of month 4. So it means that during an 8 months period, they foresee a contraction of approaching 6%. Now, that is humongous. It is actually shocking if you consider that they predict that the economy would decline in South Africa just under 1%, approximately 0.7% per month. Now, that is absolutely unheard of, and it is quite dramatic as far as the impact on our economy would be concerned. And you'll see a little bit later. And we need to understand the impact of this. Now, what is interesting is that Richard Downing from the IMF says that the cash flow problems occasioned by the economic downturn and crisis will actually continue throughout the rest of 2020. And with specific emphasis on the disruption of the supply chains in particular. And what is also interesting, they expect loss of businesses and consequently job losses. Now, this has already started. Just for interest's sake, I read a newsletter from the Law Society of South Africa and the Northern Provinces this morning, where they actually refer to the legal profession as a profession under extreme threat and in crisis. Now, let's just consider that for a moment. Any business whose business is based on the rendering of services, and it's not an essential service. In other words, it is not an essential service like a hospital or a medical doctor, or in certain instances, IT, etc., then it means these businesses have been closed since March, which means these businesses will be closed and remain closed for a period of approximately 5 weeks. Now, that is severe because as a rule of thumb, you can accept that a business which renders services makes its money by providing services. And most professional occupations, bond originators, etc., they actually render professional services. So what happens is that the rule of thumb is that the overheads of such a business is anything between 65 and 80% of turnover. Now, they have ratios which they consider to be good or bad, but in general, the reality is if you provide a service, then and you own your own business, you will probably fall in the category where between 65 and 80% of the money that you collect would go towards overheads. Now, that is actually quite dramatic. And if you consider for a moment that if you use the example and say my turnover is R1 million a month, and 80% of that would be used towards my overheads, then it means 800,000 of that would go towards my overheads, and the 200,000 would then be my profit. Now, if I talk about overheads, then I talk about expenditure in general, and that would include, for example, rent of your building or the installment that you pay the bank if you have a bond over your offices and you own it. But the interesting thing is that we have to remember that 20% so-called net profit would exclude tax. It means you will still be taxed on the 20% that you've then made. Now, if you have been unable to work and render your service for a period of 5 weeks, then what it literally means, your expenses, the 800,000, would not go away. It'll still be there. But if you were really fortunate enough and you collected 50% of what you normally would have earned if you had been working full-time, then it means your income would be 500,000, but you will still be liable for your expenditure normally in the sum of approximately 800,000. So immediately during that 1 month, you would come up short with a minimum of approximately 300,000 Rand. So that is quite significant. Now, no matter how we look at it, the reality is if the IMF and most of the economists, if they are concerned about this, then there's really good reason for it. Because the other consequence that we fail to understand is this. If you have a running operation and for 5 weeks you haven't been able to work, and for the 5 weeks you have now also made a loss for that period of approximately 300,000 on the example that I used, then it would mean that you would deal with a knock-on effect, as they call it, beyond the lockdown. Because you would really start feeling the pinch towards the end of May. Because during April and for at least a week in March, you didn't render any services. You didn't do any work for which you would then expect income. So if you look at this example, then it means the knock-on effect is immediately at least 60 days. Does this make sense? Anybody who didn't understand this? Over and above this, now you've had a large number, and I'm going to show this to you, the estimations. We'll see a little bit later. A large number of businesses who would not be able to continue, and they would then close their doors. But it doesn't end there, because of all the employees who have traditionally been employed by these businesses would then immediately be jobless. They would be unemployed, and that, of course, would add to the burden of the fiscus or the state, because these people would apply for unemployment insurance, etc., etc. So this is actually quite devastating, and we shouldn't lose perspective if we look at it. Now, if we look at the expectation that we will lose businesses and jobs, then it means the following. On the one hand, people who own properties will stand to lose these properties. The second consequence is people who would normally, in the normal course of events, continue to purchase property would then not be in a position to do that. In addition to that, the tenants who are in rental properties, in other words, our clients, we as property investors, we earn our income from renting our properties to tenants. And the reality for us is that a person who's lost his business and or his job would now not be in a position to pay the rent. Now, for us, that is, of course, of real importance. We're going to deal with that in more detail later on. So as far as rentals are concerned, you have two realities. The first reality is the tenant who temporarily during April would not be able to pay the rent or only a portion of it. And then the tenant who lost his job and who would from there on in not be able to pay me my rent. So we have the two categories there. It's a real threat, but we have, as a rule, solutions for these challenges. Now, those of you who have in the past attended seminars and workshops would immediately remember that there was always much ado about, let me just try and admit the people who I see Chetty is battling to get access. So if we have a look at this, we have always maintained that if you have anything extra, the first thing is, and Gerrit will tell you this, you always apply for an access bond, as Standard Bank calls it, or if it's ABSA, then it's called a flexi bond, etc. They all have different names for it. But the reality is, we have always maintained and we have always implored you to get, number one, an access bond, or flexi bond, and anything extra that you may have paid into that access or flexi bond. Now, if you have done that, and as I said, I know most, if not all of you here today, and I know many of you have in fact been doing that. So if you have done that, then well done, because you will be able to ride the storm. In the second instance, if you have not done it, then it's a good time to start doing it. The other issue here is vacancy provision. We've always said you have to provide for vacancies. Now, if you have one property which you're renting, then of course your vacancy provision would be a higher percentage than what it would be if you own 20 properties. It's just a numbers game. It makes sense. And again, if you have been putting away a little bit of money as a vacancy provision, and if you have been putting it away in your access or flexi bond, then again, you would have provided for the 1 or 2 months that your tenant potentially have not been able to pay you or only pay 50%. Then you would not be as concerned as many of you are. The real important issue for our purposes is that if you look at the reality of what happens from here on in, have a look at that. In the past, we have had specific methodologies to screen prospective tenants. We will have to rethink our attitude here. I'm not sure how many of you remember approximately 3 years ago, we had a workshop where we specifically discussed the issue of blue chip employers. Now, just to refresh your memory, at that point in time, I explained that the blue chip employer is not equal to a blue chip company as you would find on the JSE, the stock exchange. Because these large mining companies may be blue chip stocks or blue chip companies, but as far as I'm concerned, they're certainly not necessarily or automatically blue chip employers, because they're subject to the whims of the economy. And if you're employed by one of these large mining houses, you're more prone to losing your job than what you would be if you were, for example, employed by national government. So the reality is, one of the issues that we've resolved to address in more detail in future is when we screen our tenants, we will have to include in that screening an additional consideration. And that consideration is as simple as this. Is my prospective tenant employed by a blue chip employer? A blue chip employer is very often a company or an institution which renders an essential service. Did this make sense? I hope so. So, if you're employed by a medical doctor or a hospital, or a debt collector for that matter, or government, etc., etc., then you are employed in the environment of an essential service, and the reality is that this tenant is more unlikely to lose his job than would be the prospective tenant who's employed by a large mining house. Now, the reality is many of these large corporates are to some extent providing an essential service. Now, let me just immediately stress this. Housing is an essential service. And not only the housing or the building itself, it's also water and it's electricity, it's maintenance services. So believe it or not, even though a municipality is not considered by any means to be a blue chip institution, it is in most instances a blue chip employer. So I cannot stress this enough. We will have to address this. And in future, when we do the screening of our prospective tenants, we will have to look at who is the employer of my prospective tenant. So if this didn't make sense, you can ask me about it when we get to the questions and answers. Now, just for interest's sake, there's a dramatic decline in vehicle sales. And just to support my point, a vehicle, believe it or not, is not an essential. We have a reasonably dependent public transport system in this country. And I'm not sure, because most of us here are privileged. Do you realize that approximately 70% of the population in this country do not own motor vehicles? The vast majority of people in this country make use of alternative transport. So what does it tell us? Already during the lockdown, we've had an absolute dramatic decline, approximately 40% in sales already during lockdown at this point in time. So there you have it. So now, what is interesting, have a look at this. Notable negative effect on new vehicle sales in March was troubling, the chamber noted. Sales expectations and expected new orders for the next 6 months took quite a blow, as both these indexes declined by 18% in the March trade survey. Already at the end of March, 18% down. In other words, for a period of 7 days only, from the 23rd of March until the last day of March. Now, if that's not dramatic, then I don't know what is. Have a look at this. Originally, it was meant to be a lockdown for 21 days. All of you now know that it's been extended. Now, have a look at the original expectations for the first 21 days. Based on that, the SA Reserve Bank projected the loss of 370,000 jobs and in excess of 1,600 businesses to close. Now again, if we 55 million people in this country, and remember, only approximately 20 to 21 million people in this country are economically active. Now, to lose 1,600 businesses in a matter of 5 to 8 weeks is unheard of and is actually devastating. So keep that in mind. And this was the expectation when it was still expected to be 21 days. Now it's gone up to 5 weeks in total. Now, what is interesting is the Reserve Bank governor had this to say prior to the reality that it would be 5 weeks. Both the supply and demand effects of this extension would reduce growth and deepen it in the short term as businesses stay shut for longer and households with income spend less, Reserve Bank Governor Kanyago said on Tuesday. This will likely also increase job losses with further consequences for aggregate demand. The impact will be particularly severe for small businesses and individuals with earnings in the informal sector. So, what is the reality if we look at it from that perspective? Is we can be 100% sure of this. Businesses will fail, people will lose their jobs, and the economy is going to take an immense hammering, to put it mildly. Now, Sibongile Khumalo is another writer whom I follow. Also, she publishes most of the articles in News 24. Have a look at what is the consequence of the Reserve Bank's reaction to this threat and the authorities. By now, we have at least a 2% cut in rates. But what is interesting is the following, is according to BNP Paribas, following the recent measures aimed at cushioning the weak economy against the virus, including the Reserve Bank's first rate cut at consecutive monetary policy meetings in nearly a decade. The repo rate now stands at 4.25. Now, what is interesting is this. Look at this. And people like Gerrit would know this already. So, sorry, Gerrit, I'm telling you something that you knew before I knew it. But have a look at this. The expectation of the people who are senior economists is that the Reserve Bank will actually drop the interest rate subsequent to lockdown with at least 125 basis points. Now, for those of you who don't know what it means another 1.25%. Am I right, Gerrit? So towards the end of the year, we can look forward to another 1.25% drop, which would bring, just for interest sake, prime lending rate back from 7.75 to 6.5. Now, again, that is unheard of. And we're going to have, in the analysis after this, we're going to have a look at it, and you'll see how dramatic the impact is. So now they went off on a tangent about the job of the National Treasury, et cetera, et cetera. We're not particularly interested in that, even though it's interesting, but we're not going to deal with it today. It's a subject for another day. Now, what is interesting is the following. Tito Mboweni, who, as far as I'm concerned, is actually a pretty good Minister of Finance, has no choice but to revise the national budget across the board. Every single thing that government does will suffer as a result of this. Because if 1,600 or 2,000 businesses and hundreds of thousands, if not millions of people lose their jobs, you can understand immediately that the fiscus, the bank account of the government, when we talk about fiscus, F-I-S-C-U-S, it is just the Latin word for the government's purse. If the fiscus will have to deal with the reality that a large number of businesses and individuals will stop paying tax for the simple reason they will not earn any income, which means they will not have to pay tax. Now, from the government's perspective, if they have to balance the books, it is going to be a massive challenge. Now, have a look at what BNP Paribas had to say. Have a look at this. Revise South Africa's 2020 GDP is gross domestic product. In other words, everything that we build and earn in the country, and the growth forecast, they have actually amended that to a minus 8.5% for the year. So you can see they're far more negative in their expectation than what the Reserve Bank is. Now, if you go and look at the history, I personally think the Reserve Bank is somewhat optimistic, and I firmly believe that BNP Paribas probably have it right. We can expect over a period of 8 months for the remainder of the year a contraction in the GDP of around about 8.5%, between 8 and 9%. Now, again, I cannot stress how dramatic that is. They have downgraded that from their previous estimate, which was a contraction of 4%. Now, there's a reason why in South Africa we expect these dramatic contractions. And it is, we were already in recession before lockdown. So we have been on a downward curve before coronavirus and lockdown hit. So it's a compounded effect. But now I've given you a lot of bad news, and hopefully I now have your attention. I'm like whom of you know what a polismos is? A polismos in the old days, before the Phase Act, people referred to people who provided financial services, insurance services, policies, and that's life policies, referred to them as polismosa. Now, nowadays we don't do that. It's politically incorrect, and the Phase Act dramatically changed the conduct of financial service providers. But they always used to say, give your client or your prospective client all the bad news until he's thoroughly frightened, and then you sell him a policy. Okay, let me sell you a policy. There's all the bad news from here. But have a look at this. You remember I told you that I normally, maybe I didn't, but BNP Paribas are actually pretty accurate in what they predict. And what they say beyond the contraction for the year is, look at this. For next year, during the period 2021, they expect a growth of the economy in approximately 2.3%. Originally, they predicted 2% for next year, 2021. They have now increased that expectation with approximately 0.3%. What is the reason for that? It is because you cannot go lower than bottom. And very often we say, you need to hit bottom before you can go up. And this is what is called bounce back effect. So from the ashes, the phoenix will rise, so to speak, if we can add a little poetry to it. So there's our expectation for next year, an increase in the growth of the economy of approximately 2.3% next year. The Reserve Bank is more or less on par with that prediction. And let me just see, there's somebody, I see Adrian is reminding me to mute everybody again. Mute all, there we go. So what now happens is the following. The Reserve Bank expects the GDP for 2021 to grow with 2.2%. Now, if you look at that and you compare it with what BNP Paribas expect, then it is pretty much on par, if you look at that. So it's not my opinion. People who are really very clever at this, they are more or less unanimous about what we can expect. So that's part of the good news. What am I saying to you as far as this is concerned? We have to see through the rest of the year. We have to survive the year 2020, pardon me. So what then happens, Davy Rood is an economist at the Efficient Group, and he is particularly skeptical about the improvement of the economy. And what he says is we have a history, and that history is not a good history. Our economic history is negative in the sense that it has been in decline for many years. And currently, the unemployment rate is sitting at 29%. The truth is, it's worse than this. What Davy Rood didn't add to this is the 29% is actually calculated by people who, by referring or including people who are actually still actively looking for jobs. The people who have given up and the people who are not attempting to get jobs for whatever reason, they're not included in this 29. So the reality, the real number is far higher than 29%. The reality is young people between the ages of 18 and 25 at this point in time, at least 50% of them are unemployed. Now, if that's not a threat to socio-economic welfare of a country, then I don't know what is. So keep that in mind. Now, then Rood, as I said, goes off on a tangent, and of course, and BNP Paribas as well. They expect and they demand from the government to make some really bold decisions. Now, that's not the topic of the discussion today, so we'll see what comes out of it. I follow this keenly and closely, but they're absolutely right. Something will have to be done as far as structural changes to the economy is concerned. Very well. Now, have a look again, our old friend, IMF. The lender, IMF, has called the pandemic an unprecedented threat to development in Africa, with the region's economy set to shrink by 1.6% in 2020, and real per capita income is projected to fall by 3.9% on average. That's the IMF. Now, the reason why they have such dire predictions for Africa is because Africa was not particularly impacted by the 1929 depression in the same way that the United States and England and Europe were at that point in time. So for us as Africa, it is unprecedented. That's 100% correct. We have never seen this before, and the reality is in fact that no matter how we look at it, this is uncharted waters. We will have to find the solution. There's no doubt about it. Okay, now, as far as the continuity in rental income is concerned, I will have to if we have a look at this, we wrote this with the intention that we're going to send it out. We actually didn't send it out to the members for the simple reason we wanted to change this due to the extension. Now, I'm still going to send it to all of you. There's a little bit of background, and the question was, the results were the following. Subsequently, tenants would be sequestered at home and receive only a portion, if any, of their salary. If your tenant will receive 50% of his normal salary, and that's par for the course, does it then mean they only have to pay you 50% of the monthly rent? The answer is simply no. The reason for it being, and you may be aware of the fact that there's much ado about the so-called vis maior, act of God. Now, the underlying legal principle is this: if you're a party to a contract, and because of vis maior, you are unable to perform in terms of the contract, then you're excused. Now, a good example is this. The landlord lets a property to the tenant. One of the obligations of the landlord is to provide the tenant with unencumbered, free occupation. Now there's a big flood, massive storm, and the house is damaged beyond repair to the extent that it's not livable. Now that act, that storm, that tornado, or whatever it is what they refer to as vis maior, an act of God. So what happens now is the tenant, sad as it is, cannot demand from the landlord vacant occupation because the property is not there anymore. It is not anything that's occasioned by the landlord. It is beyond the capacity of the landlord to provide vacant occupation because the storm demolished his house. Now, that's vis maior. Now, this, just for interest's sake, in the legal profession, there is, in fact, many opinions that will provide a defense to a commercial or an industrial tenant, or a commercial and industrial building, where the point of departure is the following: to say, I'm not allowed to work, so I'm not at my shop, if it's a commercial or an industrial property. So the fact that I cannot pay you as the landlord is because of vis maior. By law, I'm not allowed to get in my car or take transport, go to the factory and go and work. And my employees are also not allowed by law to go there. Now, there's actually a valid point to say that I cannot pay my rent to the landlord because of vis maior. I cannot earn an income. I cannot occupy the building. I'm not allowed to go there, and therefore I cannot pay the rent. Now, there is, of course, one or two people who didn't think this through properly, who said, but would this be the same with residential rentals? The answer is absolutely no. For the simple reason, the tenant is in fact in undisturbed occupation of the rented property. So there's no doubt about it. And you have to distinguish between the two. The tenant is in fact sequestered in the property. He's there day in and day out. He's not allowed to leave. Which means by law, there is absolutely no doubt that the tenant cannot be excused from paying the rent. There's of course a difference between what the law says and what the reality is. So, if the tenant is not going to receive a salary or only part of his salary, is he going to be in the position to pay the rent? The law says he has to, he's not excused. But practically speaking, he's probably not in a position to do this. So I was asked the question by a number of P3 members. So what now? My answer was, do nothing. If your tenant doesn't approach you, then do nothing. The tenant remains liable to pay rent and probably should have received up until the end of March salary. The problem starts from the 1st of April and until the end of April. There's going to be the challenge. Now, so what's the solution if the tenant doesn't pay you? If the tenant approaches you, and we've had it, where a tenant says, I'm not going to receive my salary for April, and alternatively, I will only get 50%, and please will you help me? That is the point in time where you react. And it is as simple as this. If you have been putting away money in your access bond, and if you have been providing for vacancy, then of course it'll be easy for you. So what do? You simply provide the tenant with an acknowledgement of debt. If the tenant has to pay 6,000 a month and will only be able to pay 3,000 at the end of April, then that tenant is going to owe you 3 grand. Then what you do is a written acknowledgement of debt, which is signed by the tenant, where he says, I acknowledge that I'm duly indebted to my landlord in the sum of 3,000 rand plus interest. And I, the tenant, hereby undertake and promise to pay this 6,000 or 3,000 plus interest over a period of 3 months or 6 months or whatever tickles your fancy. And it's as simple as this. So you will recoup it with interest, but it means at that point you have to be proactive. Now, what happens if you failed to put away additional capital in your access bond, or if you didn't get an access bond? Alternatively, if you didn't provide for vacancies, then your last resort is the following. If you are up to date with your bond installments, every single bank in this country, well, okay, I don't know about the Grahamstown Building Society, but most of the, if not all of the large banks, you literally pick up a phone or you send an email, or you call your private bank or whatever, and in a matter of minutes, you can arrange for a moratorium or a payment holiday. Now, I warn you now, if you were in arrears with your bond prior to lockdown, it is unlikely that the bank is going to grant you a payment holiday. But so be it. Then you'll have to take further legal advice. But as a rule, if you are in good standing with your bond and at your bank, then the reality is the bank is going to be probably more than happy to assist you with a 3 months payment holiday. Now, for 3 months, you will not have to pay your installment, and then you can survive the 1 month or half a month or 2 months that the tenant didn't pay you, and hopefully in respect of which you would then get that in installments with interest. Good. Everybody understood that. Now, if you are in that situation, on your screen, if you dot it down, I think what I'm going to do after this seminar, if you're interested in getting some of this information or the email addresses, if you're in a position where you're going to need some help with an acknowledgement of debt for your tenant who would only be able to pay partially or not at all, please contact us. We will assist you with that acknowledgement of debt, and that can be forwarded to your tenant. I hope that deals with that. And now, good. If you're all ready, then I'm just going to mute all again. And you will remember that if you do want to unmute yourself, just move your cursor to the left bottom of your screen. And good. What we have done is at the point in time where we had a look at the bad news, and then what are we going to do about loss of rental income and practical approaches to how do we deal with that loss of income. And then, of course, the continuity in rental income. And then at this point in time, if you are ready, Gerrit, let me see if you're back yet. There you are. If you are ready to proceed on your side, I'm just going to, I see you are unmuted. So the floor is yours. Everybody, just for those of you who have not had all the previous experience and had the opportunity to deal with Gerrit and Green Doors, they are our partners. They do the bond origination, and they've been making it possible for all of us to invest in property. And Gerrit is going to have a few words with us. Gerrit, the floor is yours.
Thank you, Gert, once again for opportunity, and hello to everybody. I don't know all of you. I don't think I've met all of you as yet through the seminars that we have done jointly with Gert. But once again, thank you very much. Gert requested me to speak to you a little bit in terms of the expectations, the current situation with the banks, and also what we can expect. Now, Gert, firstly, to answer your first question, in some way, in 2008, the interest rate was 15.5, and as we know, that was the highest it's got since then. And the interesting fact is that when we experienced the credit crunch during 2008, 9, and 10, is that the rate went up. And in the situation that we are now, where it's not necessarily a credit crunch, but the symptoms and the prognosis might be the same at the end, the interest rate has been lowered quite substantially. So it's just an interesting observation for me. Then since 1948, Gert, until April this year, 2020, the average rate in those years is 10.25. So it's a clear indication of how well below we are currently below the average rate since 1948.
Sorry, Gerrit, since 1948, the average was 10?
10.25.
Interesting.
All right, and then before I get to the banks, because that's ultimately where everything's going to end up, I've got some interesting facts just to illustrate on where we as bond originators and some of the estate agents and the developers and the investors like you are might find interesting. Now, the opportunities exist for young people to enter the property market, as I've read that the average age of a estate agent is 60 years old. Now that's quite, I thought it's less, but I think that creates an opportunity for our market to be renewed. I think we will get across new thinking, new ways of doing business, new ways of putting our products out there, and new innovative ideas in terms of how to be a property owner. So as first point. The second point, the average age of a first-time buyer in June 2019, that's almost a year ago, was 34. Now, that creates the opportunity, because then it begs the question, what does the guys do until they're 34? So they're renting. So in terms of that, it sketches a huge opportunity. It creates the opportunity for you guys that are investing into property. 20%, our experience is that 20% of buyers is first-time buyers, and the estimated average age of a bonded home buyer is 37 years. So it clearly illustrates that there's not a history of or a tendency in our society to become property owners at an early stage. And that's why also I refer to estate or to young buyers and estate agents that's fairly old, an opportunity for young people to engage into the property market, especially now. What are we doing, or what are we trying as an industry to advance to going forward? At the moment, our bond origination industry is lobbying for two things quite strongly with government, and the one is to get the deeds office opened. And we know that it's not just the deeds office, there's other functionalities going with the deeds office in order to make sure that there's a registration taking place. But at least to get the deeds office opened and to get the properties in the holding cells, if I can call it that, to move forward. And then the most important one that we are lobbying for is to increase or to do away with the transfer duty for the next 6 months up to an amount of 3 million. It's like a payment. It's not a payment holiday, but it's just to give relief to in the next 6 months period, because we're already finding, and that's where I'm going a little bit further in terms of where the banks are moving to, and we found that in 2008, 9, and 10 as well, as that the loan to value percentages dropped from 100% and even 105%, where it's currently at. Some banks are advancing 105% loans to the lower income market as well as to first-time buyers. That might now again drop back to 90 or 80% loan to value, which will then incur deposits. And where would one get that type of money to pay up front for a deposit? So if we can succeed in getting the transfer duty done away with up to a market of 3 million for 6 months. We believe that will create an opportunity for someone to use the money that they would have used for transfer duty to rather than be able to put down a deposit on the property. But that's in the pipeline. Many banks are offering bond relief, and Gert, you referred to it. I'm not going to go into that, but in itself, there will be opportunities created. A couple of facts. Sales volumes in the upper price market has declined quite substantially. And if I refer to the upper price market, that's from 3.5 million upwards. Data shows that market volumes declined by 40% year on year already. So that's an indication of where the market is going. Although once the lockdown is lifted, surely there will be a movement in the market again. On the bottom end of the market, we feel that the structural supply, there's a huge deficit in the structural supply on the bottom end. That was one of the main performers up to now for the last 24, maybe 36 months in terms of the lower end of the market in property terms. And we have seen a lot of developments taking place in that market from let's say 650 to about 1.3, 1.5 million. So there was a lot of movement in terms of developments taking place, which most of them will be on hold in terms of the lockdown. And the buyers in the pre-sales and the developments is what worries us. We found that F&B is quite busy with re-looking at final grant acceptances in the pipeline. So they are busy reassessing, doing dipstick checks in pending bonds before registration to see whether the guy's credit record or the affordability has been affected. And they have access to that information, and they can see whether a buyer or a new owner has taken up some more debt, which will have an effect on his affordability, and then that results in F&B. And we had quite a few the last 2 weeks already, where the bond has either been withdrawn by F&B or the loan to value have been lowered from 100% to as much as 75 or 80% based on those two facts. So that's quite a worrying factor, and it's not the clients requesting the banks to lower to lower the bonds. It's F&B is embarking on a definite strategy in order to protect their book, or that's what they would call it. From Standard Bank, ABSA, and Nedbank's point of view, we have not experienced that. We have submitted quite a few applications during lockdown to these banks, and they're all still keen to do business in spite of having skeleton staff in the various centers. So we haven't experienced any change in policy from the banks as yet, as far as Standard and ABSA and Nedbank is concerned, but there's definitely an indication from F&B that they will be stricter. So the question begs, will there still be 100% bonds? And I can say yes, there's still an appetite from the banks to do business. How this will affect after lockdown, the areas of concern, or not concern of, it might be concern, let me call it a concern, is overtime, where potential buyers relies on overtime to make up for the income, or straight commission earners. Those will be the guys that will most probably suffer from a bond qualifying perspective. And then also self-employeds, where the banks will definitely look very carefully in the type of industry the self-employed is, his managing styles, the term of being in a business, his experience in that business, and then obviously the state of the financial statements up to now. The good news as far as the property house prices, and I read somewhere it dropped 2.8% year on year. So that's the lowest since 2011. The uptick on that point is affordability. A lot more people will be able to afford a bond. If you look at the repayment on R1 million bond, on the current rate of 7.75, it's in a region of 8,209 rand, and you need to earn roughly 28,000 to qualify for a bond of R1 million at the moment on the low rate. Whereas last year this time at a rate of 10%, you needed earnings of 35,000 to qualify for the same bond. So it's about 8,000 per month shift in order to qualify for the same bond than what you couldn't do a year ago. So there's a lot of opportunities, I believe. The best product for investors is still ABSA's product where they allow us to make use of rental income. None of the other banks are using or allowing future income to use as a qualifying factor except ABSA, and we've done quite well with their product that's specifically designed for investors. And to date, we haven't had anything adverse from ABSA as far as that is concerned. So what I read and what we're preparing ourselves for in the industry as a sharp decrease in volumes of business. But if I interpret it correctly, it will be a short-lived period, and that gives an investor like you guys most probably between 8 to, you will know better, but maybe 8 to 24 months to capitalize on potential distressed selling. We got news yesterday that a lot of the banking officials that we are dealing with on the sales side have been rerouted to call centers that's being flooded with calls as far as homeowners being in distress. So we expect that to be a reality soon. Then also a big focus on re-advances on properties. Gert, you also alluded to that. I expect that a big portion of the business that we are originating to banks also will be from a re-advance perspective, to either to up the cash flow or to pay accounts or whatever the case is. So that in short is that there's no real changes from a banking perspective. They're all keen to do business. I've been in contact with all the banks on almost a weekly, 2-weekly basis to be kept up to date in terms of what their thinking is. No real changes as far as policy and stuff is concerned, but I can really think that will be in a month or maybe 2 months' time, when the reality of the job losses and the decrease in earnings will definitely filter through. And once a bank sees his bad debt percentages starting to rise, then they will definitely start tweaking on the assessments of bonds. So guys, if you want to buy and on the opportunities that exist, I suggest we do that as quickly as possible.
Very much, Gert. It was a very interesting subject, especially at this time where there's so much of uncertainties.
Yeah, Waldemar, you're jumping the gun, pal. We still have a little bit to do. It's probably because you're hungry and you want to go get lunch.
Okay, no, thanks. I thought that's the.
Okay, no, we're still busy, you guys. So we'll have a look at that after we're done. So I'm just going to unmute all of you again. Now, we're going to have a look at what all of this means in practical terms. So I'm just going to share another document. Now we've dealt with a number. Can you all see that? Okay. We've dealt with a number of practical considerations. Now, Johnny, you will find this really interesting, because I know you bought actually quite a number of these. We're going to use a specific property in a development called Snowden. It's in Florida, to illustrate these principles that we have now described. Now, let me just see, there's somebody who needs my attention. It says Tabiso, network is very slow. Okay, that's fine, Tabiso. We'll keep on, I'll be on the lookout if you knock on the door again. Now, what is interesting is the following. Now, this project, we're now busy with it. It's another one of our good partners. What makes this one pretty unique is, Gerrit, this is actually the project where the developer is the first year's levies are free. And then the developer also provides a 2-year rental income guarantee. So in other words, the developer will guarantee during the first year the rental, and will then also for the second year guarantee a 6% rental increase and guarantee for the second year the rental income. So it makes it quite an extraordinary development and project at the moment. The bad news is I think there's only 41 left. People like Johnny climbed in from the word go, so they're responsible for the dwindling numbers. Now, so let's use this one to illustrate the realities. Now, if I say I'm not going to pay any additional capital on my installment, we know that the projected capital growth, because this building, this scheme is 3.5 years old, so we've been able to determine the actual capital growth, which is 6%, and we are guaranteed for year 2 income growth of 6%, and that's also based on the historical income from these units. We know that the inflation rate is pretty much there, and we don't expect it to change dramatically in the foreseeable future. And I used an example of one which the price is 762,300. What happens is interesting. This is that interest rate of 7.75. Have a look at this. If you all look at that, I just want to increase the size of that. Make it even bigger. It's too much. Okay. You all see that. That's your installment on Snowden. If you pay a 5% deposit, Gerrit, you spoke about future developments where that might not be possible, but just to irritate Johnny, I made it a 5% and not 100% bond, which gives you a deposit of 38,000. And the income and expenditure is demonstrated. But if you look at this, at 7.75%, your installment will be 5945.19. Now what happens? 4 weeks ago, remember that number, 5945. Look at the difference. 4 weeks ago, this installment would have been how much was it? It was 5945. It would have been 700 Rand per month more. And this is what Gerrit also alluded to, is that it makes such a dramatic interest. Now, just for interest's sake, if we do get, during the course of the year, our further 1.25% less, remember that, what I should have done was, there we go. My apologies, I used the wrong one. So at the moment, it is 7.75, and if we get another reduction of 1.25, somehow there we go. Okay, so if that prime rate goes down, Gerrit, to 6.5% from 7.75, then our installment comes down to another 5399.33. Now, if you do this, 5399, that's 54. Look at where it came from 4 weeks ago. 68, and potentially that 6869 will, during the course of the year, come down to 5399. That's a significant difference, and I think, Gerrit, that is what you meant when you said ride the wave before it's actually curling. So you can see this makes a dramatic difference. Now, I just want to show you something, that if we change the term and we make that, for example, $15 years. You see how big the difference is. Then it goes up to 6.3. Am I right? There we go. 6.3 as opposed to 5.3. It's 1,000 Rand difference per month between 15 and 20 years. Now, what is interesting is this, is what makes this exceptional is you will see levy is during year 1, you actually don't pay levy. You only start paying levy from year 2 onwards. Now, if you have a look at what happens with this, there's your rental income. This is what that tenant is paying at the moment, as a matter of fact. And if we get to the point on these numbers where it's down to 6.5% prime rate, this property will actually, from day 1, have a surplus. You see that, Gerrit? Donovan, if you're online, just unmute yourself and say hello. I think Don is not online at the moment. But so what is interesting, if I make that 0 and I pay Johnny, as you like to do, nothing, by the time that interest rate is down from the current 7.75 to 6.5, from day one with 0 deposit, it's cash positive. What is interesting, during year 2, for the whole of the year, I will have 1,000 Rand shortfall for that year, because in year 2, I now start paying levies. That this makes sense. So, if I start out at 7.75% and I pay no deposit over 20 years, I start out with a 398 Rand, basically 400 Rand per month shortfall, which is exceptional. It's extraordinary. Bianca was just saying it's almost unbelievable. Now, this is what Gerrit meant, is that it is exceptional that we have these rates. And what is more astonishing is that they will actually probably reduce this even further during the course of the year with another 125 basis points. Let me just see. Let me admit Miva. Now, I just want to make sure that what happens is then interestingly the following. I had a look at, if I don't pay any deposit, and if I pay 7.75% interest over 20 years, how much would I actually pay for the 762,000 property? You find it here at the bottom. Have a look at that. During year 3, the total capital that I would have invested in this property, remember, I'm not giving a deposit, and I only have a shortfall during year 1, 2, and 3. I would literally, and listen to this carefully, I would literally pay for a 762,000 Rand property, 16,312. That's what I will pay for that property. Now, this is not nonsense. It's as simple as this. Did I pay a deposit? No, no deposit from my pocket. And now you understand why Johnny is always adamant, I don't want to pay a deposit. It's not because he's bloody stingy. The reality is he understands, Johnny, that the less of your own money you put into it, the higher your return on investment, and the lower the amount of capital that you actually pay for this property. So what happens is this, is have a look at this. If I say I'm going to give a 20% deposit, watch those numbers in this line. Have a look at this. Then, let me show you again. 0 deposit, then I would pay for 762 properties, 16,312. If I give a 20% deposit, I will pay out of my pocket for that same property 152,460. So Johnny is not stingy. He's just clever about it. All that he's doing is saying, I want to pay for that property if I can. I want to pay 16 grand for it. It's as simple as that. Am I right, Johnny? So,
Yes, Gert, you're 100% right.
good. Of course, you would agree with me. Now,
If I just wanted to ask you a question quickly when you were explaining to me about the interest rates. If the development people are going to pay the bonds for us, as you mentioned, the 2 years, as interest rates goes down and up or whatever, is that going to fluctuate?
no.
Or, because
What
I
the
would
de-
like it if it can stay on the high side. For instance, 6,300 or 6,800. That means I'll pay the property off quicker
Look,
if he pays that amount.
what the developer is saying is, at the moment, the tenant who is in that particular property, I'm sorry, Johnny, if you don't mind, this property is actually one of yours. I hope you don't mind.
I don't mind.
This is one of those you bought. Your
Yes.
tenant at the moment in that property is paying 6,586. That's the rent that tenant is paying now.
Okay.
So what the developer is saying to you, he says, for the next year, I will guarantee 6,586. And then he says, I will further guarantee you.
Even if that 1.25 percentage is going to go down, is he still going to keep on paying that amount?
Yeah, because remember, that's the current rental.
Okay.
So he's just guaranteeing the current rental. So then he says, I will guarantee you for the next year rental every month of 6,586, and then he says, for year 2, I will guarantee you 6,981.16 for a year.
Sure.
Did you understand
Excellent.
that? So
100%.
he says in year 1, I will guarantee you every month. If the tenant doesn't pay, I as the developer will pay you that rent, 6,586 every month. And then from month 13, he will guarantee you every month 6,981.16. And
Okay.
whether the tenant pays or not, you will receive the rental because there's a written guarantee. You will see in the contract there's a written guarantee at the last few pages. So that's what it means.
Okay.
Now, it is a lengthy process that we actually got to the point where it was possible to arrange this. And now you also understand, similarly to why I say we have a great partnership with Green Doors. Similarly, we have a really great partnership with these developers because they take it seriously and they're prepared to actually put their weight behind this and make it worth a while. Now, I just want to take it back to where it should be. Now, if you look at this, then you will see that if I don't pay, you remember at the beginning I spoke about additional capital reductions and keeping some sort of vacancy provision. Now, there's your vacancy provision. I want you to see the numbers. If I say, okay, I own 20 properties. So my risk is spread over 20 properties. Now, as far as any other property is concerned, if I own 20 properties, I would make my vacancy provision 2%. And that 131 on every single property, I would hide under my hat. Okay. But with Snowden, I wouldn't make any vacancy provision at this point in time because my rental income is guaranteed. Did this make sense? Good. But what I would do is the following. Remember, if I don't pay a deposit at the current interest rate, and remember, Johnny, on most of your bonds, for example, you have prime less rates, if not all of them, as a matter of fact. So it is actually less than 7.75%. So what happens now is, remember I said that additional repayment? Have a look at this. If on this you pay an additional amount of 1,000 Rand per month, before I do that, I want to show you. If I don't pay anything extra, at the end of year 10, my property will be worth 1,365,163 Rand. Have we got it? 1.365 million. And I will owe the bank 521,000. See that? Now have a look at those two numbers, specifically that one and my equity. Let me just explain this before I enter that. After 10 years, your Snowden will be worth 1.365 million. You will owe the bank 521,000. So your equity in the property is going to be 843,000. You agree with me? Now have a look what happens if I pay an additional 1,000 per month. Watch those numbers. That one and that one. Incredible, isn't it? Now, if I pay 1,000 Rand per month extra, my property is still going to be worth after 10 years 1,365, but I will only owe the bank 341, and my equity in the property is going to be 1,024,000. Did everybody get that? Simply by paying 1,500 extra, and that will make my shortfall 1,398.97 per month if I pay 1,000 extra. Now let's make it interesting and say I'm going to pay extra. Again, look at those numbers. If I increase that to 1,250 per month, then I owe the bank after 10 years less than 300, and I have equity of 1,170,000 approximately. Now you will see my installment obviously is going up, and what will now happen is my shortfall during year 1 is 1.6 per month. And now if you compare that to the scenario where you paid a 20% deposit and where the property cost you, can't even remember the amount, 152 it would have cost you. If you rather pay an extra every month in your kitty, in your flexi or your access bond, then the total amount that you will pay for your 762,000 property is 88,389. That's what you will actually pay for that property. Okay. Good. Anybody who didn't understand that, raise your hand. Nobody. Great. Now, what happens is the following, and this is the really interesting thing. We're going to have a look at it. You will see that if I pay 1,250 per month extra, instead of 240 months, I will have this property for 166 months, the bond. Now, if I make that really ludicrous and I pay 2,000, then my term comes down to 141 months. And by the end of 10 years, I will only owe the bank 160. So this is a principle that we've explained over and over. And now what is interesting, 2,000 Rand a month extra will mean I will actually pay for this property 151,387. So, but have a look at your return on investment. 158%. See how it changes your return on investment if you reduce your own contribution. So the bottom line is this: the less money you put into this property, the higher your return on investment. Have a look at this. If I make that 0, have a look at that return. Why is it possible that I can have a return of 955%? Because I never put any money into this, except for the first 3 years. So what I put into this is, let's do that, equals that.
Sorry, Gert, can you share the screen with us? I can't see the screen. I don't know about the other people. I only see your face.
It is shared at the moment.
I can see the screen.
I can
Can you
also
see it? Sorry,
Yeah.
I don't know. I don't know why I'm not seeing the screen. I'm seeing your face.
Okay, Johnny, let me have a look. I just want to.
Okay. Sorry, I've seen it now. Okay, right. Thanks.
Right.
Sorry. Okay, I'm seeing it now. Thank you.
Okay, that shouldn't be percentage. Okay, have a look at this. I can increase the font size there. So if you ask me, because I would have asked, how is it possible that my return on investment can be 955% in a year? The reason for it being, in total, ever, the only money that I will put into this property is 16,312 Rand. And you calculate your return on investment on the money which you take out of your own pocket. So that income that you see there and that capital growth which you see there, can you actually see on your screen if I move the cursor? I get that growth, that price and value escalation, and that income by investing 16,312 Rand. Gerrit, did it make sense? Good.
Perfectly.
Okay. Now, what is interesting about this is the fact that the more money I put into this property, the lower this return. Let me just do this by way of deposit. 10%, look at that, comes down because right at the beginning, I shoved 76 grand into it. Now, because of that 76 grand, I have this massive decrease in return on investment. But okay, now I don't have any monthly shortfall, except in year 2, a tiny shortfall. Okay, now, what is interesting about this, and we're going to have a look at it now in due course, is at the end of year 5, my property is now escalated in value from 762,300 to 1,020,000. But I owe the bank 598 by then. So my equity in it is 319,750. So I use this to predict when I will refinance. One of the issues that Gerrit discussed today is exactly that. Because that 390 is nice and handy as a deposit on at this point in time on 2 or 3 or 4 new properties. If you look at that. So I can predict it at which time by looking at the numbers. I can predict. Now, I normally start looking at round about year 5. And we're going to have a look at it in due course. Now, what happens is this, let me just see, there's somebody who wants my attention. Now, I can see the screen. Jan Harm says he can see the screen. Okay. Good. Thanks, Jan Harm. Now, what is imperative about that is that you need to decide for yourself. Johnny says, I don't want to put money into this. I want the tenant to pay the whole damn thing. And he says, I will not pay any deposit. And because he says, what I want is I want that massive return. Some others would say, look, I'm just going to pay my 10% and I would accept the reduced return on investment or real rate of return, but I'm not going to have any shortfall. Now, this depends exclusively on whether you have the deposit or not. Andrew, I see Andrew says I must share the screen again. Anybody else who cannot see the screen? It looks as if everybody. Andrew, you must just have a look at your settings, please. Okay, everyone else is seeing it. Andrew, just have a look at your screen, at your settings, because it's not on my side, it's obviously on your side. Now, once we've done this, then I can predict when I will use the equity in this property to expand my portfolio 3-4-fold, 4-fold, 5-fold. Now, these are the real numbers as they are actually at the moment. So I'm going to stop sharing this one and I'm going to show you another one. If I say, for example, let me just see. Okay, everyone else is seeing the screen. Okay. Now, I'm going to show you, if we take the argument that these are the numbers 5 years ago, to demonstrate Gerrit's point and to underline what I'm explaining, if we speculate that this was 5 years ago, then let me just quickly get the other one. You see it now? There we go. What happens is the following. You remember we said we're going to speculate. Today is the 17th of April. Now, the numbers that we showed you now, that was, for argument's sake, the 19th of April, 2015. Okay. So here you see the values that we had on the previous one. My bond balance now at this point in time, if I bought Snowden 5 years ago, my bond would now be sitting at 598,387. I would have 180 months left on my bond. My original bond was for 686 because I paid a 10% deposit. And currently my rate is 7.75 or less. And I bought the property for 672. At this point in time, my rent is now escalated after 5 years to 8,300 a month. So what do? This is now 5 years later. I go and I take the value of the property as it is now. Remember, I bought this property 5 years ago. I bought the Snowden. So at this point in time, my property's value is now 1,020,000 Rand. So what I do is I go to the bank, I ask for 240, 20 years bond, and I say, okay, I only want an 85% bond. So the bank will re-advance on this property 867. Currently, I owe the bank 598. The bank is now, if I only use 85% loan to value, will now give me 867. Everybody with me? Good. Now what it means then, my installment is going to go up to 7118. My levies would have also increased over the last 5 years, and it's now sitting at 700. Same with agents commission. And I'm now going to pay the attorneys bond cancellation fee to cancel this bond, plus the transfer, to transfer, for example, this property. Yeah, this should be less because this is just a bond cancellation and the bond. So let's just work on around about 15, yeah, let's call it 17,000. So this money I'm going to pay the conveyancing attorneys because I'm cancelling that bond and I'm now registering that bond. That this makes sense. I bought Snowden 5 years ago. These are the numbers as they are now. I will continue to pay this. Cancel this bond, I pay the attorney. Register this bond, I pay the attorney. It's going to cost me about 17, give or take. Now what happens is my installment is going up. So I'm again at the point where I'm having a small shortfall of 371 Rand per month. Now, what is interesting, the system calculates the money that I previously paid by way of deposit. So now, instead of paying 16,000 for the property, I will in fact pay over this long period 174,000. But I will again, just that first year, have a tiny shortfall, and then I'm again making money on it. This, by the way, is one of the ways in which we reduce taxation. Instead of continuing to get an increased income, I refinance, and I now get a smaller income from year 6 onwards. Actually, I make a loss. And from year 7, I now actually get a smaller income, and it grows, grows, grows. But I take the money that I receive net here. This is what I get after 5 years by refinancing. 158,000. What now happens, I take that and I buy another 2 properties. and I use this as my deposit. So by cancelling this bond, registering that one, and by paying the attorneys, I get out net 158,000. Now what happens is this. This system also calculates what is my capital gains tax. Now in this instance, it's in a company, so I will pay 57,000 in capital gains. Okay. But I include this 57,000 in this calculation. So the amount that I get out net is actually 193, which means cancel old bond or new bond, less paying off the old bond, less what I pay the attorney, less what I pay the receiver of revenue. So after I've done all of that, by refinancing this property 5 years from now, I will get out 193, and that gives me approximately 23, let's say 60 or so thousand rand deposit on 3 properties, 3 new properties. Did this make sense? So, again, if I, on the previous one, I now didn't add an additional payment. So, when we talk about raising money from our equity in our property, when the interest rates are favorable, then it means we do this by using what we've already saved in our older properties, refinance it, and get money available from that, even though we are paying the receiver of revenue. Now, just for interest's sake, if at this point in time, later on in the year, this interest rate now bottoms out, have a look at these numbers. Then I will be in positive territory. So if I then do this and I say to the bank, I want a 90% bond, then for year 1, I will have a tiny, tiny shortfall, but I will walk away from this transaction with 244,000 Rand. I hope it made sense. Good. It seems either nobody is concerned about it or nobody has a question. Let me just see. Okay. Pleasure, Sean. Now,
Gert,
okay.
I've got a question, if I
Yeah.
may ask. I just want to know, I see there in that one illustration, you mentioning the agent's commission. Why do you put it in if you register the second bond? Because that agent's commission was paid the first time when we did buy the property.
Yeah,
Why are we putting it in the second time? Or is that just to
this
show?
is actually my rental agent. This is my income.
Oh, sorry. Okay. I
That's
thought
my
it.
rental
Sorry,
agent.
I didn't.
That
Okay, I didn't know that.
Okay.
And this what you illustrated to us. Is this what they call registering a second bond on your property?
Yeah, you can.
Or is this cancelling?
You can either by way of a second bond. Let me just see if I can find a field. I'll quickly do that. So your second bond would then be, if you register a second bond, then the bank would register a second bond of 319,750, or the bank could say, okay, cancel this bond completely, and at the same time register a brand new bond of 918 over the property.
With
Now,
your experience, what is the best?
Look, it depends on, let's say your current bond is with ABSA, and you now go to ABSA and say, yeah, I now want it increased to 918, then in all probability, ABSA is going to say, okay, we register a second bond of 319,750. But if it's currently with Standard Bank and you now go to ABSA, because ABSA is taking into account all your rental incomes, then they will cancel that bond completely, because we're taking that loan or the debt away from Standard and we switching it to ABSA. In that instance, it'll cancel this bond and register at Standard Bank and register a brand new bond at ABSA.
I can maybe just add that most banks will allow up to 80% of the equity as a further bond.
Okay. Okay, so it means, thanks for that, Gerrit, then it means what we're doing is, in effect, we only can get 80% of the, is that loan to value, Gerrit?
Yeah, that's loan to value. Sorry, Gerrit, I thought I was on mute.
Great, so there you have it. Now,
Gerrit?
Yep.
Can you hear me? Stephen?
Hi, Stephen.
Hi, I just got a question. Why do you pay capital gains tax when you refinance the property?
Okay.
You're not selling the property.
No, you're absolutely right. Thanks for picking her up, Stephen. What I did is I designed this, that if you own the property in your personal name, for example, let's say you own this, you bought the Snowden 5 years ago in your personal name. Now what happens is you're now going to transfer it into a company, for example. Then you're going to get your new bond and you will now have to pay capital gains tax.
I understand. But if you keep it in the same entity or if you keep it in your own name, then the capital gains tax doesn't apply.
And it won't, and this will be the result.
Yeah.
Can you see that, Stephen?
Yes.
So what then happens, it changes it to that. Because now all of a sudden, you don't have the capital gains tax anymore.
Okay.
Just for interest's sake, we always complain because people buy properties in trusts. Let me just show you the dramatic impact. If you buy it in a trust and you now sell it to yourself or your company, have a look at that capital gains tax. It is ludicrous. So, but okay, that's the reality. So for all intents and purposes, if you just refinance it, Stephen, what's going to happen? Zero capital gains tax, well spotted.
Okay, got you. Thank you.
And that obviously has a dramatic difference on the bottom line.
Yeah.
Great. So what now happens is the following, is 5 years from now, I can refinance my Snowdens and I can use the guarantee from the developer and the growth in this to know 5 years from now, I can use this Snowden to buy another 2 properties with the build-up equity in it. Did this make sense? Stephen, not if you're happy with that. Great. Okay, so I know it's a lot of numbers, But what I needed to demonstrate to you here is, this is what Gerrit said. The topic of today is coronavirus, threats, lockdown, misery. People are suffering. But if we can look beyond all this and see the opportunity for the property investor, this is the purpose of what we're doing here. It is not all doom and gloom. It is indeed so. It is a bad situation, to put it mildly. People are sick. We're all stuck at home, and certain people who deliver and provide essential services are at immense risk. But from an economic perspective, I see Saul is also getting a great Saul. Okay, happy for that. Now what happens is, for us as property investors, yes, it is a bad situation, and it is challenging, also from a personal perspective. But for you as a property investor, it presents unforeseen, number one, and exceptionally unexpected great opportunities. And I think this is what I'm trying to demonstrate here. I hope I succeeded in doing that. I'm